Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets behind big business, that is, until these companies decide to spill the beans in their own words like Accenture just did with this massive proxy statement. It is packed with details about how they run things, how they pay their top brass, and what their plans are for the future, so buckle up because we are about to decode Accenture so easy. Accenture just dropped their 2025 proxy statement, and it is a deep dive into their executive compensation board structure and future plans. Now, before we get into the nitty-gritty, if you appreciate getting straight, unvarnished insights from these corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we dissect these filings together. Let's dive straight into the numbers, because that is usually where the real story lies. Accenture's fiscal year wrapped up on the 31st of August of 2025, and they are showing some pretty interesting performance metrics. They reported revenues of $69.7 billion, which is a 7% increase from the previous year. That sounds good, but then they also mentioned new bookings decreased by 1%. Even with bookings over $100 million from 129 clients, which is a record, they also generated $5.9 billion in generative AI bookings. So while revenue is up and AI is a hot ticket item, that slight dip in overall bookings might be something to watch. Now, speaking of those records, the company has an impressive lineup of director nominees for their upcoming annual general meeting in January of 2026. They are proposing 10 nominees, and it looks like 9 out of 10 are considered independent, which is a strong governance signal. They are also highlighting a good mix of skills on the board. For example, they have 6 out of 10 with CEO leadership experience and 10 out of 10 with global experience. Also, 10 out of 10 have innovation and technology backgrounds, so they are obviously leaning into that technological future. Their strategy is pretty clear. They want to be the go-to partner for big companies looking to reinvent themselves, especially with artificial intelligence being a huge focus. Accenture is investing heavily in this area, as you can see with their 975,000 people and their focus on AI and data professionals reaching 77,000 against a goal of 80,000 by 2026. They also invested $1.5 billion in 23 strategic acquisitions to bolster their growth and capabilities. Let's talk about the top executive, Julie Sweet, as chair and CEO. Her compensation for fiscal year 2025 was significant. Her base salary remained at $1.55 million, but her global annual bonus was $4.5 million. This bonus was up considerably from the previous year, reflecting the strong company performance and her individual achievements, the target values for her. January 2026 equity awards were also substantial at $16.5 million for the Key Executive Performance Share Program and $6 million for the Accenture Leadership Performance Equity Award Program. This clearly shows the emphasis placed on long-term incentives tied to company performance. Looking at the summary compensation table for the named executive officers in 2025, Julie Sweet's total compensation was nearly $29.6 million. That might sound like a lot, but it is important to remember that a large portion of this is in stock awards that are tied to long-term performance and company results. Other executives like Manish Sharma, Chief Strategy and Services Officer, also saw significant compensation packages adding up to over $9 million in total compensation for 2025. These numbers reflect a strong pay for performance philosophy, where a large chunk of compensation is tied to how well the company performs and how well these executives manage its complex operations. Now, to keep this high-performance engine running, Accenture is asking shareholders to approve an amendment to their 2010 share incentive plan. This means authorizing an additional 7 million shares for issuance and extending the plan until 2035. They explain that providing equity is crucial for attracting and keeping top talent, and that their share repurchase programs help manage dilution. Their burn rate has averaged 1.3% over the past 3 years, which is pretty low considering the number of employees eligible for these awards. This plan is designed to align employee and shareholder interests by tying executive equity directly to company performance and long-term value creation. Moving on to auditor ratification, they are proposing to reappoint KPMG as their independent auditor for the fiscal year ending. August 2026, KPMG has been their auditor since 2002, and the company seems confident in their services. The fees for audit-related and tax services from KPMG for 2025 were around $29.5 million, which is pretty consistent with the prior year. This shows a stable relationship with their auditor and a commitment to transparency in financial reporting. Then there are a few proposals tied to Irish law for companies like Accenture operating internationally and listed on US stock exchanges. These proposals are quite standard. They are asking for shareholder authority, for the board to issue shares and to opt out of preemption rights. This is essentially to give the board flexibility in managing the company's capital structure, whether that is for acquisitions or raising funds, and they are seeking approval to do this for up to 20% of their issued ordinary share capital, which is pretty common practice. This next proposal is also routine under Irish law, and it involves determining the price range for reallocating treasury. Those are shares the company buys back. Accenture plans to use these for employee compensation. And incentive programs, the price range for reallotment is set between 95% and 120% of the market price, with exceptions for compensation. Programs, which is a way to manage the cost and value of these shares effectively. Now let's look at the bigger picture with Accenture. They are clearly pushing hard into AI and digital transformation, leveraging their vast global workforce and strategic acquisitions. Their financial performance shows steady revenue growth and a strong focus on shareholder returns through dividends and buybacks. However, the slight decrease in new bookings, while still historically high, warrants a closer look. It could signal tougher competition or a shift in how clients are contracting for services. Their executive compensation is heavily weighted towards performance-based equity, which is a good sign for shareholder alignment. But the sheer scale of these awards, even with clawback policies in place, might raise eyebrows for some investors. The company's commitment to strong corporate governance with independent directors and transparent practices is commendable. The risks they highlight are standard for a global tech consultancy, including economic downturns, competition, and geopolitical instability. Ultimately, Accenture seems to be navigating a complex market with a clear strategy focused on reinvention and AI. They are investing in people and technology, but need to ensure that their booking growth keeps pace with revenue, and that their incentive structures remain sustainable and fair. The market is competitive, and while their current direction seems sound, maintaining that edge and delivering consistent growth across all metrics will be key going forward. Alright, that is our breakdown of Accenture's latest proxy filing. What is your take on these numbers and what they signal for the company's future, especially their AI push and executive compensation strategies? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description where we can discuss these reports further. Thanks for watching, see you next time.